E agora, para ministrar a palestra Construindo Pontes entre a Governança Corporativa e a Inovação, convidamos Sr. Evan Epstein, Diretor Executivo do Rock Center for Corporate Governance, da Stanford Law School.
Thank you. So first of all, I want to thank Leonardo for inviting me to this conference. I think it's a very important topic of fintech, and it's great to be back in Brazil. Rio is a great city. Every time I come here, I feel it's a wonderful place, and I want to come back. So what I want to do is talk about corporate governance and innovation. It's something that we do very focused in a very focused manner at Stanford. And I want to go through some topics here. So first of all, what I want to do is talk about the role of Silicon Valley in innovation, and with that, the founder narrative. So there's something very strong in Silicon Valley about founders that I think impacts a lot on governance structures. Okay, so the second thing is the phenomenon of staying private, or unicorns, and this is something that is happening today, where companies, and particularly tech companies, are deciding not to go public, and this is affecting as well and changing the landscape of corporate governance. And there is something called a unicorn, which we refer to companies that are worth more than $1 billion, that are software, US-based or global-based companies, and that is a big growth area. There's a governance twist to what's happening, and this is multi-class stock voting in the tech industry, and this is at the core of corporate governance because it's how companies and founders are keeping control of their companies and decisions, and this is a change only in the last decade, and I'll talk about that, and I'll give you some statistics. And obviously, I will talk very briefly because we're going to have a full day of discussions on fintech, but the new models of capital formation and the rise of fintech, I think the issues that everybody's discussing are crowdfunding, blockchain, robo-advisors, and marketplace lending. These are the issues that, at least in the United States, but I know everywhere else, and of course here in Brazil and Israel and every other market, is a big issue in development. And finally, I'll talk about the next chapter in corporate governance, and I'll talk about some of the issues that are affecting companies and what we should think about when we talk about fintech. So the first thing is Silicon Valley. You know, Silicon Valley is relatively new. The word itself only starts in 1971. The region used to be an agricultural region. There is some history of technology. Of course, HP was founded in 1939. And of course, Stanford has been a very big factor in developing technologies. In fact, there was a 2012 study that tracked about 40,000 companies to Stanford. And some people said, out of these companies, there's 5.4 million employees, jobs. And if you would track these companies, it would be the 10th largest economy in the world. So of course, Stanford, I think, has been a big part of that. And but really, if we want to think about the modern startup, you have to go back to Fairchild Semiconductor. And there's a story that I think is very educational, which is the story of the Treacherous 8. And this story is really how you can think about startups. So William Shockley was the inventor of the transistor, and he won the Nobel Prize in Physics in 1957. And he founded the company. He was in Bell Labs in New York, and he decided to go to Palo Alto and found a new company based on this transistor. But in those days, the industry didn't exist. So he hired a lot of young engineers, which at that time they called hot minds. And the idea was to start a company, but he was famously a very difficult manager. And these young engineers decided, we don't want to work with him anymore. But in those days, you didn't leave a company as a group. And so 7 of them decided to send a letter to New York to one of the father who was a broker and an investment bank. And Arthur Rock, who's actually, the Rock Center is named after him. He was an investment banker, and said, hey, this is really interesting. I'll go to San Francisco, meet with them. And he decided, why don't we start a new company where all of you can be there? So you got to remember, in those days, venture capital didn't exist, or it was very, very limited. And this is the first time that some company was started that way. And it was very hard to raise money. Nobody wanted to give money. Famously, he called about 37 companies and nobody wanted to fund it because they said, well, we can hire the group, but we're not going to start a new company. Eventually, Sherman Fairchild from Fairchild Camera said, okay, we're going to give you $1.5 million and we'll have an option to buy it for $3 million and a later date. And so that was the start of Fairchild Semiconductor. And if you think about the different waves, of course, the 40s and 50s was very driven by defense. But in the 60s, integrated circuits created the semiconductor industry. And you have Fairchild, you have Intel, AMD, that all came from that. And every other decade, the technology has been building on the same idea. And so, of course, you've got personal computers in the 70s, you've got biotech, you've got networking companies in the 80s. In the 90s, we have the internet. In the 2000s, we have social networks. And in the 10s, we have this mobile revolution and this famous phrase that software is eating the world, that is coined by Mark Andreessen, one of the famous VCs and former CEO of Netscape. So this is the picture of the Treacherous Eight. Robert Noyce is right there in the middle. And all of them are very famous in Silicon Valley, because after that, what you can see is that there is this fair children, as they call them, which out of that company came the whole industry and many companies after them. And this is an idea that I think has kept Silicon Valley where you can go and leave a company and create a new company. In fact, if you fast forward to 50 years, in 2007, we have what some people refer to as the PayPal mafia. So very similar, as you can see. It's a picture, of course, it's a fake picture as the mafia, but it's interesting that you have a similar pattern where, you can have these PayPal children, where out of PayPal, you have all these new companies that have been created. So most famous in that list is Elon Musk with Tesla, with StartX, but you name them. There's YouTube, there's LinkedIn with Reid Hoffman, Rolf Butter is a famous VC in Sequoia, and so forth. So this is a pattern that we've seen over and over in Silicon Valley, and I think it's a very important pattern, and it's what we call, a narrative of the founder mentality. There's a great article by the writer Tom Wolfe that is the description or the idea of Robert Noyce, and he calls this idea where they came and created a new company and people left defection capital, right? This is an article from 1983, by the way, which if you read it today, it really could be written about Mark Zuckerberg, it could be written about Steve Jobs, but Robert Noyce was, in his generation, the leading tech person. And also there's an idea that he wanted to leave New York or the establishment. He didn't want to have a hierarchy, and the West Coast Silicon Valley is very informal and is built, and every company since then has had this ethos of being informal, of not wanting to have certain privileges. Robert Noyce was famous for having his office in the middle of the floor, of the main ceiling. He didn't have a corner office, no parking privileges. And if you go to companies in Silicon Valley, that stays the same. You fast forward to 1999, there's a great book by Michael Lewis called The New Thing. Again, it's a description of a founder called Jim Clark, who founded 3 companies worth $1 billion, Netscape, Silicon Graphics, and Healthion. And he says, this founder is to Silicon Valley what, Silicon Valley is to America. So we have a very strong founder profile. You go recently, Peter Thiel wrote this book, 0 to 1, and here he talks about, there is this idea of progress. You can have vertical progress or you can have horizontal progress, where vertical progress is where you go from 0 to 1, meaning you create something new, and this is where Silicon Valley and technology thrives. Whereas you can also have horizontal progress, which is going from 1 to n, right? And he says this is where other countries, particularly China, takes technology, copies it, and it is progress, but it's not the same thing. And he basically says new technologies tend to come from new ventures, and this is where Silicon Valley kind of thrives. All right, so we go into technology, what's happening, and we've had the first presentation where the exponential growth of technology has been tremendous. There's a great book called The Second Machine Age from some colleagues at MIT, and they say, look, you had the Industrial Revolution, which really was about powering machines. You have the all the steam engine, but now it's all about this mental power. The computers, you have software, you have big data, you have robotics, and it's really powering at a curve that is really exponential, and that is pushing things at a rate that we don't know. As we said before, it could be tomorrow, it could be in a week, it could be in months. Things are moving very fast. There is a discussion there about whether there is a substitution of jobs, of people, and this is another big area. Inequality in Silicon Valley is a big discussion, I think, everywhere in the world, and with the rise of technology, there is this idea as well. But let's talk now about why companies are staying private, and this has the governance component, right? On the first place, there is the Jobs Act in the United States in 2012, which allowed companies to have more shareholders before going public. So it used to be that if you had 500 shareholders, you would have to file as a public company. Now it's 2,000, so companies can stay private a little bit for longer. There have been secondary markets created where people have recognized, look, if we are staying private for longer, we have a need to some liquidity for owners, for employees, for maybe investors. And it used to be the companies would go public in 4 years. Now it's taken about a dozen years to go public. So there are these secondary markets, second market, shares post. Now NASDAQ has consolidated not the NASDAQ private market, and this is a change. And by the way, this market has been, there's a lot of things happening, particularly now with all the, unicorns, these big companies like Uber. There's a lot of trading of these private shares that before didn't exist. There is a big surge of public investors going into private markets, right? So you've got mutual funds, we have sovereign funds that now have decided to invest in these companies as private companies and not wait until they go public. So the wealth creation is happening very much in the private side and not the public side. So before, you couldn't have a company worth billions of dollars in private, they had to go public. That has shifted. And also, one of the reasons why this has shifted is there are favorable investment for these public companies. Now they can invest with different terms like liquidation preferences. They have IPO ratchets. They have downside protection that you can't have in a public market. And this we'll discuss a little bit about this. And this is part of the governance discussion. Obviously, there's a fading Silicon Valley public company. There used to be in the late 90s about 471 public companies. Now it's down to 275 companies. And this has shifted a lot. And this is something that we're going to talk about. And also companies are going private. This is another, sector of the economy where companies have decided they don't want to be subject anymore to these rules. They want to go private. And also there's a big surge of shareholder activism, which is something very particular to the United States, but they don't want to be subject to this activism. So, the landscape has changed. And the landscape, particularly in fintech, is part of this new landscape where not only do you have late-stage funding, or VC, but you have new entrants. You have the traditional public investors, the Fidelities of the world, the BlackRock, the Vanguards, all these big investors are coming in. The big corporations are investing. So Google has Google Capital. You have, Rakuten. You've got Alibaba. The Chinese companies are investing in these private companies. And so that is changing a lot the discussion. We have discussed about the fading U.S. public corporation. The numbers of IPOs have decreased. The number of companies have gone about 9,000 publicly traded U.S. companies to about 4,000 and a bit more than 4,000. And one of the things that has allowed this to happen, in part, was the creation or the utilization of dual-class shares. What does it mean? It means that you have differential voting where the founders of the companies can have control and they issue shares that don't have control. And even though they are uncommon in the United States, there is a long history of dual-class shares. In fact, in the 1920s, there was a Harvard professor who called this a plague amounting to the rape of ordinary shareholders' voting power. And in fact, between 1940 and the 80s, it wasn't allowed in the New York Stock Exchange. And then in 1988, in fact, the SEC, under the pressure of a lot of issuers, there was a lot of takeovers in those days, and they said you have to allow us to have takeover attempts and put dual-class shares. But the court decided, no, SEC, you don't have the authority to do that, so they pushed it to the listings, and the listing said, you can have a dual-class share IPO, but you cannot reclassify from if you have common shares to a dual class share. So that's the situation in the public markets. Typically what you have is a Class A share that has 1 vote, and a Class B share that is not listed that has 10 votes. And Google was really the first company in the tech industry that found this, and they said, you know, if we're going to go public, because we're forced to go public, we want to keep control. If you read the S1 from Google, there's a lot of influence from Warren Buffett and Berkshire Hathaway, and they say, you know, the best form for us to go public is to have dual class, to remain and have the flexibility of being private. But as I was doing a lot of research, there is actually one precedent in the tech industry, which is Genentech when it went public in 1980, but for purposes of this discussion, we can talk about Google. So 14% of IPOs in 2005 have used some form of dual class, compared only to 1% in 2005. And if you look at all the latest crop of US companies or global companies with tech industry, they've all gone public with dual class shares. So Google, LinkedIn, Zillow, Groupon, Zynga, Yelp, Facebook, you name them, right? The reality is, if you dig a little bit deeper, and I use this quote from George Orwell from Animal Farm, all animals are equal, but some animals are more equal than others. They change, and they're very different between them. So Facebook had a very strong form of dual class share, where Mark Zuckerberg kept a lot of control of the company, not only through his Class B shares, but he had voting agreements with other people Class B. So he had, with about 15% of the equity, he had about 60% of the voting control. So a very strong form of control. But this year in June, they did a reclassification of the shares, and he said, I'm going to issue Class C shares that has no voting power. And it's not new, because Google did this in 2013. And one interesting element of what he did was that now Mark Zuckerberg, whereas before if he died he could name a successor, now his shares are tied of him being a CEO or him being a chairman or him being part of the management. So it's actually an interesting middle ground of what we are seeing. But a lot of them are different. Zynga has 3 classes of shares with differential voting structures. You have different flavors upon conversion upon sale. You have sunset provisions, which means now companies are saying, look, we can go public, but after a certain period of time, our shares will convert to common. So as you can see there, Pure Storage just went public and they have a 10-year limit. You have Yelp, Fitbit, and Aptio has a 7-year limit, and Nutanix has a 17-year limit. I don't know why they picked 17 years. It sounds a little bit strange, but there are a lot of different ways to do this dual class shares. And so one of the questions is, what Google did, now Alphabet did, will this follow through where companies that have dual class shares will have a triple class share? And you can see with Facebook and Zillow that this will probably happen. So now we go into the unicorn phenomenon. So unicorns, as I mentioned, there was an article by Eileen Lee. She's a venture capitalist. She was a former partner of Kleiner Perkins, one of the big firms, now at Cabo Ventures. And she wrote an article and she found that there were unicorns were companies that were worth more than $1 billion, US software companies. She found 39 of these companies in this club. By January of 2015, Fortune came up with a list of 80 companies globally. And today there are 177 companies in this category. A lot of them, 97 of them are in the United States. China has had a big surge, 38 in China. In the United States, about 2/3 of them come from the San Francisco Bay Area. And the valuation of all these companies is about $640 billion. So this is a big development in the capital markets. It's a big development in company formation. And now we have what we call decacorns. They have to invent new words at a rate that is higher than our imagination. So a decacorn is a company that is worth more than $10 billion. And there's already 15 of those. The list of unicorns, I know it looks very small there, but you have at the top, you have Uber at $68 billion. And from there, it is incredible the pace at which they're growing. I apologize because I believe you can't see very well, but this slide, what it says is, these decacorns now in this environment, and you can see here, don't need to go public anymore in the public market to have a valuation of $10 billion. So you have companies like Dropbox, Airbnb, Pinterest, Uber, Snapchat that actually are worth more than $10 billion and don't even require to go to public markets. It didn't used to be this way, right? Before, what this line in orange is when you have to be when you trade in a public market. So there's a big change in capital markets in the United States. The big change, and governance, we'll talk about how that impacts governance structures. Of course, this has been driven by a huge surge of investment. In the last 2 years, there's been about 3 times more investment from 2013 to 2015, it went from $25 billion to $75 billion, and a lot of that is driven by the late stage. So this is Series E. In venture capital, we invest in different series, so Series A, B, C, D, and in this, you can see how the surge here goes from like 3.6 billion to 20 billion, and that's where the mutual funds and the public companies are coming from. So what we have is different downside protections that have impacted this. And in M&A, there are companies that have liquidation preferences and senior liquidation preferences. And this, as you can see, has grown and has allowed the companies to invest in these terms. In the IPOs, we have what we call IPO ratchets and IPO blocking rights, which has provided the late stage investors with a lot of rights. It's changing the dynamic of the companies, and it's hurt a lot of recent IPOs, Square and Box and other cases where they're obliged, they want to have this unicorn term, but the terms actually are pretty onerous. And the reality is now we're seeing a bit of shift on the private market. Some people are talking about a bubble. Are these private companies overvalued? So there are these down rounds, and there's a tracker that says since 2005, there's 93 companies that are down rounds. So they were, getting valued at a higher number, and then at some point it goes down, and this impacts a lot of what is happening. Fidelity, for example, which is one of the public investors, has done a lot of markdowns, which means because they're publicly traded, they need to report what's the valuation of these companies, and this has created a lot of tension between the venture capitalists, which are private, don't need to report it, and the public investors, and this is an interesting discussion. If you look at the unicorns, well, here it's an amazing development because these unicorns have extreme super voting power. So you can see in this slide, at 10,000 to 1, remember it used to be 10 to 1, now there are companies that have 10,000 to 1, Theranos, which is a big governance scandal in the United States. If I have time, I can discuss about that, as 100 to 1. And private companies like Snapchat, SpaceX have already a triple class share structure at a private level, right? So this is a huge change in what companies have and used to have, and we're tracking a lot of this. Part of Silicon Valley is also a lot about failure. Mark Andreessen has this discussion where he says, look, 95% of the returns are driven by 1% of the investment. So you have to be, a very top company to drive, to be valuable. And he says the venture capital industry is driven by a power law distribution. So in Silicon Valley, there are about 4,000 startups that are looking for investments every year. You can only invest in about 20 as a venture firm. They look at about 3,000 startups, of which 200 they look deeply, they invest in 20. But of that group, really there are 15 companies that make it and are the big winners. And so in order to have a healthy venture capital industry, they invest in about 1,000 to 1,400 new companies each year. So think about that in terms of governance. There's a failure rate that is extremely high. How do you operate when you know that in your portfolio, 7 or 8 of those companies are going to go under? And this is why it's so different, governance in the private market to governance in the public market. It's a different risk profile. I can talk very briefly about crowdfunding. I know I'm running a little bit out of time. Crowdfunding is a new development that we all know that is giving access to equity crowdfunding to unaccredited investors. It's something completely new. In the United States, it came in May of 2016. And I'll try to go a little bit quick here because I want to touch the governance issues. One of the things is there is about 120 companies that have registered with the SEC. Already 60 have gone to rise they've raised about $12 million, so it's very small at this stage, and it's still a developing market. Of course, we have the rise of fintech. The 3 technologies that everybody's talking about is blockchain, which distributed ledger technologies. This is huge. Bitcoin is a very important development, but blockchain, the underlying technology, is even a bigger development. We talked about how you can use it in capital markets. Voting shares and other issues are a big part. Robo-advisors, which is digital investment, these platforms have grown tremendously. The market can be, in the trillions of dollars. Online marketplace lending, the same, right? But let's go into, somebody mentioned there are about $19 billion invested only last year in these new technologies. So fintech plays a big role. And remember when I listed, every year, the different technologies, with clearly what's coming is fintech as the new frontier in terms of investments. So what's the next chapter in corporate governance? And I think this is where we want to discuss the last 5 minutes. So first of all, it's interesting that Leonardo invited me because the SEC Chair Mary Jo White came to Stanford to the Rock Center. We have something called the Silicon Valley Initiative, and she spoke about these developments and what are the challenges that unicorns have and specifically private companies have in governance. And so here, one of the issues is, have these boards of directors expanded beyond entrepreneurs and original investors? As I mentioned, the governance of private companies in the United States is very different to the governance of public companies, in part because there's no separation of ownership and control, right? The people that are on the board of a venture-backed company are usually the owners, are the VCs, are the founders, and rarely you will have independent directors. If you go to a board of a public company, you're going to have a majority, 84% of directors in public markets are independent directors. So it's a different dynamic on how governance is driven. Second, do these directors have any regulatory expertise and specifically industry expertise? And here I can talk a little bit about the Theranos case, which is a medical device company, $10 billion unicorn, and has, if you're following the news, at least, I don't know how much you follow in this space, but in the United States, this board was famous because it had, Henry Kissinger, George Shultz, about 6 government, famous or very important government former authorities. It had military, former generals, admirals, but nobody really knew about medical and scientific devices. So what did the board do? They eventually changed from the board of directors. They created a board of counselors, and now that board of counselors has been canceled. And this is a big governance scandal. A lot of lawsuits. It just came out that a lot of people have lost a lot of money. Including George Soros apparently, and Rupert Murdoch, and different people. So this is something that in the private space we are seeing scandals of this order that are different to public markets. Whether board of directors understand the fiduciary duties and that they extend to all stakeholders. So one of the big cases in venture capital is that you have dual fiduciary duties. As a venture capitalist, you have a fiduciary duty to your investors, but if you invest in a company and you sit in a board of a company, you have a fiduciary duty to that company. In certain scenarios, maybe a merger, a down round, a recap, what's going to happen is an inherent conflict of interest. And usually your duty as the board member is to the common shareholder, not to the preferred. There's a lot of lawsuits. There's a famous case. There's a Trados case. There's 9 Systems. And this is creating, differences on how directors have to behave. We run a program at Stanford called the Stanford Directors College for Venture-Backed Company Directors. And it's amazing to me how many directors of venture-backed companies don't know their main fiduciary duty goes to the common shareholder and not to the preferred. And so we are looking at these issues, and I think this is changing a lot on the landscape. Finally, of course, by not being public, you are instituting internal controls over financial reporting to avoid errors and misconceptions and valuations. As I mentioned, valuations are a big part of the differences between private markets. We have very high valuations, and what's happening is when they go public, today the public market has a lot of discipline in the tech, particularly after the .com, where a lot of public investors were burnt. Now there's a little bit of a inverse where the private markets are very frothy and the public markets are valuing at a lower scale. So when you think about corporate governance, these issues are significantly different, and you have to think about how, as a board of directors, you protect your investors that are now in a different setting than in the public markets. So I don't know if we have time for questions, but that was a little bit, I know I rushed a little bit through these discussions a little bit quicker than what I wanted, but I think I'd be happy to take any questions here or later. So thank you very much.